With the S&P 500 trading at 23 times forward earnings, it's becoming harder and harder to find great buying opportunities in this market. Even Alphabet or Google, which I like very much, and it's still one of the cheapest of the big seven, it's approaching 20 times earnings. So it's becoming very hard to find some kind of an amazing quality company trading at fair value, or even better, trading at an undervalued price. But I have two stocks that I'm going to talk about today. And I actually own those two stocks in my portfolio. The first one is a stock that I've talked about many times. I'm going to give you guys an update because there has been some meaningful changes over the last few days. So I have to talk about this one. The second stock that I own has recently experienced a pullback, and I believe it's starting to present a great buying opportunity. So I really hope you enjoy it as always. Now, the first one is Uber. Uber is up 44% year to date, but the stock is still extremely cheap relative to the fundamentals of the company. Many of you may remember Uber as a company that used to lose money, as some kind of a garbage company, and it used to lose like $5 billion a year in 2019. Now they're making $8.5 billion a year. So it's a totally different story with a company like Uber. They have expanded internationally. They have a market leadership in 8 countries, massive growth, 82 billion in gross booking. It's a totally different company from what it was in 2019 and 2020. They have over 170 million monthly active users, growing 14% year on year. Their trips are growing 18% year on year, which is re-accelerating in terms of growth. So it's, again, a totally different company. Amazing stuff. The delivery business is booming, growing 18% year on year, and EBITDA has been expanding in terms of EBITDA margins, and the company has been getting much better in general. And the vision for Uber is to become the everything app. By the Everything app, it means that if you want to order anything related to alcohol, anything from Home Depot, if you want some kind of tools at your job site or something for your pets or anything, you don't have to even wait overnight for Amazon. You could get it in 20 minutes with Uber. So the reach that Uber has is unmatched. Not even Amazon will be able to match the speed of delivery that Uber has access in split seconds. So the network and the business model that Uber has is much more than an app that anyone can just create and then they just have their own app. It's not as simple as many people believe it is, and it is becoming some kind of a super app, you could say, and is finding a lot of success. Now, many of you guys know that Uber and Waymo have been partnering together, and they've been expanding in new cities through the Uber app, where if you want to order an Uber in Atlanta, Georgia, or in Austin, Texas, you have to order the Waymo, through the Uber app. And this has been the partnership between Uber and Waymo. But very recently, something has changed around that, and Uber has decided to expand their partnership with Lucid and Nuro and to form some kind of a partnership, what they call next generation autonomous robotaxi program. And they're gonna partner to deploy 20,000 robotaxis over the next 6 years, and Uber will invest 300 million in Lucid. Now, this is, in my opinion, not as bullish as many people believe. I've heard many bullish arguments that now Uber will own those robotaxis from Lucid, so they actually have the control over the fleet, not like Waymo with Waymo. It's just an app, they collect commissions. And now if Uber buys those 20,000 vehicles from Lucid, they own the fleet, which is a very different setup, and it gives Uber much more control, which sounds great. But the only problem is it will put it at a direct competition with a company like Waymo. Back in 2019, 2018, Uber had their own autonomous vehicle division, and they recently asked the CEO, why did you sell the autonomous vehicle division? And there was some accidents related to that, but he did tell them that if we directly own autonomous vehicles, we would be at competition, direct competition, with companies like Waymo, with companies like Tesla, and other innovative autonomous vehicle companies that are much better than Lucid. Let's just put it this way. But now, with them directly partnering with Lucid to deploy directly those Lucid cars, they're going to be directly competing with Waymo, which I believe could put their partnership with Waymo at risk over the long term. And maybe Uber knows that. Maybe Uber knows that once Waymo scales, Waymo is going to go on their own app and they're going to leave Uber. And that's why Uber is trying to get some control. But I believe that really contradicts with what the CEO said in terms of trying to partner with all those players, like be the Amazon of autonomous vehicles instead of directly owning the autonomous vehicles, which would put them in direct competition with other players. And that's why Waymo was partnering with Uber, not with Lyft. Lyft directly owns autonomous vehicles, but Uber didn't. So now with Uber directly owning those vehicles, they might risk losing the Waymo partnership. But all those things will affect Uber over the long term, but none of it is really going to happen in the short term. The stock is very cheap. It's trading at 17 times cash flow. 17 times cash flow for a company that's growing cash flow 23% this year in 2025, expected to grow 24% again in 2026. And I believe they will likely grow 20% a year for the next 5 years. So if you're paying 17 times cash flow and you're getting 20% growth for an amazing company like Uber, you're paying less than 1 time price to free cash flow growth. This is dirt cheap for a company like Uber. It has been cheap, and as free cash flow has been expanding, it's getting cheaper and cheaper. So to me, Uber is presenting one of the best buying opportunities in this market relative to other opportunities by a mile. Less than 1 times price to free cash flow growth. It's very hard to beat. Bill Ackman likes it. I still own the stock. I've been talking about it from $78 per share, and I still believe it's presenting the best, one of the best kind of quality stocks at an undervalued price in this market. But I am worried about their partnership with Lucid. I don't believe it's as bullish as people believe, but we'll find out how the partnership plays out over the next few months. And if Waymo decides to abandon Uber or what happens with the situation, maybe I'm wrong, but we'll see what happens. Now, the second stock, which I talked about many times, it was trading much lower when I started talking about it. It's a very hated one, and I'm going to tell you why it's hated. But this company is called Cheniere Energy. Cheniere Energy has recently had a pullback. It's down 6.3% over the last 5 days, and that was mainly due to some kind of a weather forecast that's expecting the weather to be warmer, which means natural gas won't be as in demand as it would have been if we had a colder weather, and natural gas prices went down and Cheniere Energy stock went down. Now, Cheniere Energy has the largest liquefaction facility in the United States, the second largest in the world. 11% of total global liquefaction capacity is through Cheniere Energy. So Cheniere takes the gas, they liquefy the gas, they ship it all over the world, they ship it to Europe, they ship it to South America, they ship it to Asia, they ship it all over the world from the United States. And this has been a key beneficiary from tariff negotiations, as a lot of those tariff deals included more purchases of US oil and liquefied natural gas, which most of it is supplied through Cheniere Energy's liquefaction facilities, which are one of the largest in the world, not just in the United States. Now, most of their shipments have been going to Europe. Now, when I started talking about the stock, they had a lot of shipments going to Asia. And people told me, what if China halts their supply, their purchases of natural gas? What's going to happen to Cheniere Energy? Is going to crash. Well, China did halt their purchases of US natural gas. But guess who took on the demand? Europe took on the demand, as you could see over here, and now Europe is purchasing more natural gas from the United States. Now, another argument I got on my last video is, what if the Russia-Ukraine war ends, Europe is gonna start buying Russian gas again? Do you really guys believe that after everything that happened in Europe and they shut off the supply and prices have spiked in Europe in general, do you really believe the EU is gonna go back to Russian gas? Do you actually believe that? I personally don't think so. And let's say they go back to Russian gas. The US and Europe are the largest trading partners. So if they don't want to buy US natural gas, they might have some consequences on tariffs. So this dynamic is not going anywhere. US natural gas is one of the best and it's one of the cheapest. It's really not as expensive as in other countries, especially close to Europe. Qatar is cheap, but the United States is also cheap, and they're benefiting now from having leverage over the tariff deals. So if Europe doesn't want them, other countries have been wanting them. And we've seen the cycle over and over again, and the exports have been going up, they haven't been going down. So I'm not really worried about it too much. And the numbers speak for themselves as everything has been getting much better in the last quarter. Now, I know many of you guys are worried about investing in a natural gas stock and you believe natural gas is volatile. You don't want to be involved with it and the whole thing is messed up. But this is not really a natural gas bet. Cheniere Energy has 95% of their supply contracted through 2030s. Most of it is like through fixed prices of 2 to 2.5 on natural gas. And if it's above 2 to 2.5 by 1, so let's say it's 3.5, they get 300 million extra. But normally, if you look at the natural gas chart, it doesn't really go below 2. So as long as it's between 2 to 2.5, Cheniere Energy will be fine. And if it's above that by $1, each $1 will bring them an extra 300 million in cash flow on an annual basis. But 95% is contracted through 2030. They have 16 years of lifelong long-term contracts remaining and over 120 billion of remaining fixed fee revenues through 2050. So most of those things are contracted for years and years out. So it's not really a natural gas bet. It's more of an infrastructure bet on liquefying the gas and shipping it all over the world. And that's not going to stop anytime soon. The company is very shareholder friendly. They take the free cash flows, they lower shares outstanding. They bought back 13% of shares since 2022. They invest in more facilities to increase production. They also decreased debt by 27%, and they also grew the dividends. So they're, again, very shareholder friendly, very smart allocators of capital. The company has a vision of spending $20 billion by 2026. They spent $15 billion so far. And they still have $5 billion left to pretty much pay down the debt and buy back stock. I believe they have like 8% of the market cap left to buy over the next 2 years by 2026 to deploy the extra $5 billion. So they, again, return a lot of value to shareholders, very, very smart capital allocators. Now, for the thesis on Cheniere Energy, they have a goal of reaching $25 of DCF by 2030. DCF is distributable cash flow. It's like their own free cash flow metric. The main reason why we use their own free cash flow metric is because Cheniere owns another company called Cheniere Energy Partner LP. And many people confused this one when I talked about Cheniere. They said, oh, I don't invest in limited partnerships. Cheniere is not a limited partnership. Cheniere Energy Partners is a limited partnership. This is another company that's more on the midstream side that pays a lot of dividends, like a 6% dividend that Cheniere owns. But if you're investing in Cheniere that I'm talking about here, Cheniere Energy, it is not a limited partnership. So because it has all those different entities, you have to use their own DCF metric. And their goal is to reach $25 of DCF by 2030, mainly by buying back stock and by finishing the expansion of their facilities, which they got the licenses to finish them under the new administration, which is very friendly for natural gas companies. So they're going to get $25 of DCF per share. The company right now is trading at 25 times cash flow. I believe this is expensive, and I would prefer to use 20 times cash flow. Okay, so we take the $25 of DCF per share and we time it by 20 times cash flow. This is $500 per share. The current price of Cheniere Energy stock is around $225 per share. So we divide it by $225 per share. This is almost 122% upside over the next 5 years with an amazing company like Cheniere Energy, 17 years worth of contracts. And this is one of my favorite stocks in my portfolio, mainly because it doesn't really behave with the market. Like the stock was going up like 8% through the April pullback. All my stocks were crashing, but Cheniere was going up. So it doesn't really care too much about what the market is doing because it has 17 years of contracts, and they just keep on buying back stocks and increasing the dividend. So it's a beautiful investment, uncorrelated investment. And I like Cheniere. I own it here. I think it's presenting a great opportunity. And same thing with Uber relative to other stocks in general. And those are two stocks I own. And I share everything I own in my own group. This is the link if you're interested. But thank you very much for watching. I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.